Hello, everybody, and welcome to the North County Estate Planning Council's June 2nd meeting, entitled Charitable Planning When the Stars Align, Why 2020 is the Year for Charitable Gifts. My name is Ollie Ben. I'm the Director of Philanthropy at the Jewish Community Foundation, and we are happy to assist the North County Estate Planning Council with their webinars. And at this point, I'm going to turn it over to Carly.
Great, thank you so much, and welcome everybody. We're very excited to be with you today. I wanted to first go through our announcements, as is our usual practice, and let you know that we're really excited to have you here and wanted to share a lot of things that are going on in our world that you might be interested in. So we welcome you and our speakers with a great presentation today. We have Steve Chedester with Withers Bergman and John Kramer of Wealth Point, and we'll get to introductions in just a minute for them. I wanted to just make an announcement. We still are looking for sponsors for our meeting. If you were interested, please contact either Bill or myself. We would love to have your support. I also want today to say a big special thank you to the Jewish Community Foundation, who've made Zoom possible, and we can't thank them enough. They're teaching us new things every day, especially me. So again, thank you. I wanted to point out that JCF, Jewish Community Foundation, has established 3 funds to address the needs resulting from COVID-19. The Vulnerable Local Population Fund supports grantees and provides critical services and support to people who've suffered from reduction in income and is unable to provide for their basic needs. Also, we have a Public Health Response Fund, and that provides health care. And the third fund is a collaborative effort with the Jewish Federation of San Diego, the Jewish Community Foundation of San Diego, and the Leach Tag Foundation. So I hope you will consider supporting them, as they were one of the first to jump out in our community and provide support. Charlene, would you like to say a few words?
Thank you. Thank you, Carly, and thank you, everybody. Good morning and welcome. My name is Charlene Wallach. I'm the Vice President of Operations at the Jewish Community Foundation, and I spend a great deal of my time working with people like you, professional advisors, on behalf of our donors and our mutual clients. I cannot begin without sharing my warm wishes for our community and our country to find a peaceful and healthy time soon. While we remain focused on helping to alleviate the pain caused by the COVID-19 pandemic through the emergency funds that Carly just mentioned, we're also addressing the racism that we've witnessed and the ensuing civil unrest in San Diego and around the country. We want you to know we've provided our donors additional resources to support their efforts to combat racism and work towards a more just, equitable, and peaceful society. And we have a lot of resources on our website if anybody's interested. The Jewish Community Foundation is pleased to partner with the North County Estate Planning Council to host this program today and last month and anytime in the future. All of you on today's call are an illustration of how you prioritize your professional development, particularly around philanthropy. How you build your practice by networking and engaging with others while staying laser focused on our broader community. We really are grateful for your work. For those of you who don't know, the foundation is the largest grant maker in San Diego, with an average of 100 million facilitated annually in grants on behalf of our 800 or so fund holders, with about 75% of those grants reaching the general community right here in San Diego. We manage over $550 million in assets on behalf of individuals and organizations for whom we hold funds. And we have held the trust of this community for over 50 years. We've had a long history of commitment to and partnership with professional advisors from the legal, accounting, insurance, wealth management, and investment fields. And together we work with individuals and families to reach their charitable goals. Today, you're going to hear from these great speakers about many aspects of philanthropic planning, including using life insurance, alternate tax advantages, Iras, QCDs, and a host of other wonderful ideas, all filled with acronyms. I'm also hopeful that after today's session, you may consider joining our Trusted Charitable Advisor program. It's exclusive at JCF, where we provide a 3-part learning environment for attorneys, wealth managers, CFPs, CPAs, insurance experts, and more, where together we review how to engage philanthropy in your business as another way to enhance your client relationships. We'll take that knowledge and information, some of which you'll hear today, and distill it down, wrap it with a bow, and make it available to you to integrate into your practice. There are many benefits to the program, now entering its 4th year, including being recognized as a TCA, a Trusted Charitable Advisor, on our website, along with approximately 60 former graduates. There's strong networking and connections, and a chance to learn about preparing for the next generation of philanthropists. Our 2020 cohort begins on June 11th, coming up really soon, with 3 lunchtime workshops between now and the end of October. Of course, we'll decide whether the next ones will be with lunch or simply remote. Details will be shared at the end of today's program, and I invite you to join us. We're also available for any and all of your questions. And as a reminder, your clients do not need to be JCF fund holders to work with us. We're happy to have your calls, and we're happy to connect with you. At the foundation, we believe that every individual can make a difference, and together we can change the world. And this is a great place to start. Thank you so much for including us. Thank you so much for your partnership, and thank you for your attendance. Carly. Carly, you're on mute.
See if we can unmute Carly.
Okay, got it. Next, we want to go on and talk about our trifectas. We actually have had great success with them, and Pete Tentler has been collecting names of people that are interested. So if you could specifically help us out by offering to host a Zoom or a webinar that would allow a small group to meet and meet some new people, we would love to have your name and contact information. So please contact either Pete or Bill and let us know if you're interested in that. Thank you. Our next North County Estate Planning meeting after today is going to be on June 7th. We're presenting the challenges, of July. And we're presenting, Don Kunin and I are presenting a session talking about the challenges we face in trying to administer accounts with all the unusual things that are going on. So it's a pretty interesting presentation. She and I both have been talking, sharing our horror stories, if you will. But I think we've got some good practical solutions that a number of you might be interested in. So I hope that you will come and listen to that and participate. And so that's the first Tuesday in July, on July 7th. Also want to give a shout out to the board. A lot of us have been giving input, and we're constantly looking for speakers, great speakers like we have today. So if you also have a suggestion for speakers, we would love to have your thoughts and input on that. Our hot topics are on hiatus right now, but we may look for a way to bring them back as well. So thanks to our hot topic people, Catherine, Christian, and Roberta, who help us out with that. We're always appreciative. So that brings us to our speakers today. Steve Chittister of Withers and Bergman and John Kramer of WealthPoint LLC. Today they are talking about charitable planning and why 2020 is the year for charitable gifts. 2020 has reshaped daily lives around the world, massive volatility, and it's interesting, when we wrote this, I don't even think we realized the volatility given what's happened in this last week. But many people are unemployed. We have the shutdown of the country caused by economic stress. We now have rioting and unrest, civil unrest in our country. And so it's a historic opportunity for charitable and estate planning and taking advantage of the depressed asset values, low interest rates, and high gift and estate tax exemptions. So today, Steve and John are going to start a discussion of how they work with clients in exploring estate and gift planning, and how they work to align their planning with their clients' philanthropic goals and wishes, including cash gifts to create charitable deductions, how to best leverage Roth IRA conversions when paired with charitable gifts, evaluating CLTs and IRA credits as combined estate and gift planning techniques, and the bonus gift that keeps on giving. So without further ado, both of them have asked that I keep their bios short, so I will do that. First, Steve. Steve is a partner at Withers Bergman in Rancho Santa Fe and has been in the private client and tax team focusing on estate planning, trust, and administration, charitable giving, and representing tax-exempt organizations. He's designed and used computer modeling to show how economic consequences of various estate planning and charitable giving techniques work for clients. He's experienced in the area of executive compensation, focusing on intermediate sanction issues for tax-exempt organizations. And he's represented numerous organizations before the IRS. In addition, John Kramer is joining us, and he's with WealthPoint Partners. He brings more than 30 years experience and background in the areas of business succession, estate planning, family wealth governance, and philanthropy. With the WealthPoint team, they work to create the synergy of talent, education, and resources for their client, creating a multidisciplinary team. John has family office and business experience coming from his role as chairman of the board for the Kramer Land Company, a family office operating in Southern California. All family owners, 140 of them, are descendants of early land grant settlers in Southern California, with Orange County business and real estate roots dating back to the 1860s. So as you can see, John has a huge amount of experience today and also currently serves as the co-chair of the Planned Giving Advisory Committee for the La Jolla Institute of Immunology. So today, welcome our speakers, and I believe John is going to start us off. Thank you so much.
All right, John and Steve, we need you guys. Oh, there we go.
There we go. Thank you. Well, good morning, everyone. Steve and I are honored to present on this topic today. Helping philanthropists with their current and planned gifts has been a passion for both of us during our careers, and we've never seen such an opportunity for us and our clients to do good. So there we go. We've seen more stress and volatility and needs in our country in the past 3 months than either of us can remember. And all of these struggles are creating a stress on our charitable safety net. At the same time as this is going on, we're seeing clients be extremely interested in their own estate planning. The combination of legislative changes, historically low interest rates, and strategic planning available to them through their advisors can create a meaningful, positive impact for our clients, their families, and most importantly, the charities they support. In our presentation today, we're going to focus on a high-level overview of the recent tax changes and the strategies that we have been implementing and can now newly implement that make a difference in our community. This is the first time we've given this presentation, and we see it as a starting off point, the beginning of a dialogue that we here in San Diego and the advisory community can have together with our clients and with each other, and in that way delve deeper on these topics. So I'll go ahead and get started. The WealthPoint, our firm, is a boutique financial services firm that specializes in succession and exit planning and life insurance advisory services for both entrepreneurial, family groups, and high net worth individuals. Steve's firm, as the introduction said, is focusing on also working with the high net worth families, but doing so from a worldwide perspective in both business, working with high net worth families, as well as the charitable planning process.
Let me just jump in and say Withers is relatively new to San Diego, maybe new to some of you. We've been here on the West Coast for about 5 years now. I think of it as a law firm focusing mainly on estate planning. It's really a boutique firm handling the ancillary concerns of our estate planning clients, but it's done on an international scale. We're probably the largest law firm focusing exclusively in that area.
Thank you, Steve. And so today's presentation, we're going to focus on that estate planning, the charitable giving, and the current giving that becomes possible and really necessary in 2020. And part of this is driven by the tax reform and legislation that's occurred over the past couple of years, and most recently in the last couple months, and the impact that will hopefully have on philanthropic planning. And most importantly, trying to focus on why 2020 is an ideal year for gifting for our clients. My perspective is we help clients at our firm with their estate planning. We help them today because of the stress in the environment and the economy, and with the tremendous amount of 40 million jobs lost and the impact that's having on all of us, to guide clients to provide for both their family and charity. And we do this by really trying to minimize taxation. And we see 2020 as really a once-in-a-generation opportunity for both estate and charitable giving. We're working very, very closely with our clients, but more importantly, we really believe in a collaborative environment of working together with other trusted advisors that our clients work with. This is not planning today that can be done in a vacuum. And we draw on the resources around us, the IRS rules, the current interest rates, the tax deductions available to our clients, as well as at WealthPoint, we have a proprietary financial modeling tool that's been developed over the last 10 years of working with entrepreneurs and business owners, which is called our IV, or instinct verification. It's a very detailed plan that helps individuals look at all facets of their financial planning, including modeling out how charitable planning will affect the family for multiple generations. And importantly, when we're doing plan giving, we rely on the plan giving community itself. We have a tremendous charitable community here in San Diego, and many great plan giving officers at various charities, including the community foundations that comprise San Diego. And we can take advantage of these platforms. So when we work with clients that are considering estate planning, major gifts, or plan gifts, we start with their balance sheet. And I think we've all had a chance in the last 3 months and the time we've spent at home to kind of look at the world around us. And I've talked to a number of people that have talked about cleaning out their cupboards. And I've learned about Marie Kondo and all the work she's doing over the past few months. And we kind of look at the work we do with our clients as cleaning out the cupboards of their balance sheet. A lot of our high net worth families have accumulated all kinds of assets and complications over decades. And when we meet with them, sometimes the first step we can take is help them understand everything they have and simplify that picture. We're currently working with a large family, a number of brothers, and the family net worth is over $3 billion. And there's over 500 different family entities. So sometimes the planning process starts with trying to simplify what are typically very complex situations. And part of that is to educate and encourage, where possible, gifts of less efficient assets like IRD and retirement plan assets, and helping clients leverage their giving by transferring the most tax inefficient assets while transferring to family members the most efficient assets. So we'll talk more about that today, and also where family, legacies, and philanthropy meet. Steve?
So my perspective when it comes to estate planning and charitable planning is the starting point is the client's objectives. And I think it really requires a balancing of those objectives. I find frequently that my clients have multiple goals that they wish to achieve, many of which are mutually inconsistent. And it's not possible to maximize the achievement of every one of the goals. And so we have to order them, prioritize them, and apply a multi-pronged approach in seeking to achieve them. This presentation, talking about charitable giving, is really a corollary to the estate planning process. I find that thoughtful estate planning for the benefit of the client's family frees the client to be more generous in their philanthropy. Often their favorite charity is the family, but once the family is provided for in an efficient manner, they're then able to move forward and be more generous in giving to charity currently and in the future. And frequently that involves using different types of charities and different forms of gifts to achieve the client's various goals. Carly referred to, John, give us the next slide, if you would. Carly referred to the stormy times in which we operate, and if these are indeed tough times, but in terms of charitable giving, this should be the perfect storm. We have a series of circumstances and factors that have combined to make 2020 an important time for giving, at least for high net worth individuals. Those of us who live on lower economic strata, I recognize these are difficult times, and many people may not be in a position to make gifts that are significant in terms of the needs, the charitable needs that are out there. But for individuals whose lifestyles and means and families are secure, this really is an opportune time for charitable giving. The pandemic has and the resulting impact on the financial markets means that marketable securities are substantially down, thankfully having recovered slightly, but still significantly down in value. Business values are often determined by analogy or comparison to public companies, and so even businesses that are still in operation and turning revenue can have a depressed value as determined by valuation experts, just as a result of the economic market that we live in. The increased volatility in the marketplace results in larger discounts. Our colleagues in the valuation industry tell us that valuation discounts for minority interests, for non-controlling interests are going to come with larger deductions from the undiscounted underlying value. Anytime you're in a circumstance of increased volatility, that's a natural impact. And then we have the applicable federal rates that are at an all-time low. You've probably seen, or perhaps seen, the announcement. I was yesterday looking back at some material, and 2 months ago, when the Section 7520 rate, which is applicable to many charitable gifts, was published by the IRS, it was 1.2%. And I sent email to some of my partners in the firm saying, this is amazing, look how low this is. This is going to make certain charitable giving strategies and estate planning strategies especially appropriate. The next month it was at 0.8%, 80 basis points. And I thought, it was the lowest in my career. And this month, it's at 60 basis points. It's even lower. There's not that much room on the low side for it to go any further. But to the extent planning transactions, gifting transactions are impacted by or influenced by interest rates, for some of those transactions, now is the time to be triggering those transactions. And then finally, we have, as a result of the 2017 Tax Act, a situation where many taxpayers still have significant amounts of gift tax exclusion available, so that some gifts that might trigger gift tax can be buffered by the application of that gift tax exclusion. The result of the combination of these four factors is that there are significant estate planning opportunities that involve outright gifts or intra-family loans or grants, installment sales to grantor trusts, charitable lead trusts. There are a whole family of strategies that are especially suitable for our times. The challenge, of course, is how to communicate that message to the clients that we represent in a way that they can understand and appreciate without overwhelming them with all of the potential detail. I put together a matrix to help them compare, because John, next please. It's not just a question of listing off all of these various topics, all of these various strategies, but each one of them has a different impact. Some of them will trigger gift tax and others will not. Some transfer existing value of assets, and others are designed to transfer just the future appreciation. They're freeze transactions that only transfer increases in value. Some require a valuation, others will not. Some may have an impact on capital gains recognition, either currently or in the future, and some will require gift tax returns, while others may not. The matrix that you have here is one page that lists a handful of related organizations, balances those factors in a way that I hope the client can understand. And then in the final column, what I call amplification, talks about, if you like this idea, how could you amp it up to have more of a wealth transfer impact in these times. Next slide, please. That matrix is not in the materials that were circulated to you, but if you go to the URL on the screen there, tinyurl.com/low-v-low-r for low values and low rates. That will take you to a memo on Google Drive that you can download. And you're welcome to if there are any ideas that would be useful to you there in communicating with your clients, you're welcome to use that as a way to help them to see the possibilities that are out there. And as I said earlier, I find that estate planning for the family is intimately related to charitable giving, because until the family's needs are cared for, clients are reluctant to be giving assets or making commitments to charity in a substantial way. And now is an ideal time to be addressing the family's needs. Next slide, John.
Thank you, Steve. I'm going to take a couple.
Would you please?
Here. Yeah, thank you. And as Steve said, that matrix has been already very helpful to me in my practice, and I will continue to rely on it. So please avail yourselves of that. We have several different legislative acts we're going to talk on, and the first is the Tax Cut and Job Act of late 2017. And this was established, as you know, to stimulate the economy, to lower tax rates, which they did for individuals by several percentage points. And most importantly, there was a tax reduction for most entities. The 21% flat rate for C Corps was a tremendous drop from where it had been before. And also for many qualifying pass-through entities like S Corps, LLCs, and limited partnerships, they are able to get a corresponding reduction in their tax rates. And there were lots and lots of tax benefits included in all of these tax acts when they're done. They're hundreds of pages long. And I think and found it very interesting, one very obscure one that really applied literally to maybe a few thousand individuals was a adjustment in a recent revenue ruling in 2020 that actually applies retroactively back to 2009. And it's just something that I was interested in because I work with life insurance and helping clients that no longer need their policies sell them into a secondary market. And it's obscure, not very many people do it, and not very many clients that have policies. And I was very surprised to see a whole section of the tax code around this. And what it allowed individuals to do is to go back and relook the sale of policies they've done in the past, basically be able to increase the basis significantly in their policies and refile and reduce the taxes on these sales of policies. And it allowed them to go all the way back to 2009. And again, remember, this is probably affecting just a handful of thousands of individuals in the entire country. And yet these tax acts are written with these types of very specific elements in them. And when we look at that and we run across clients that have done this in the past and have the ability to go back and refile for these refunds, it's a great time for us to ask them to consider making a gift. And you'll see in the context of how we move forward, and we talk about other tax benefits for business owners where it creates an opportunity to remind someone of a tax saving that they hadn't counted on, and where it can create kind of a foundation for some of the estate planning and gift planning that they may want to consider in 2020. Probably most important out of the Tax Cut and Job Act was the increased gift and estate tax exemption, which is currently $11.5 million per individual, $23 million per couple. That is due to sunset in 2025. And what we're encouraging clients to do is to make those transfers now, because there's no guarantee that they'll be here till 2025. But the gifting they do now will be guaranteed and will not be pulled back into their estates. So we think it's an important time, along with all the other reasons we'll cover, for doing your planning now. There was no exceptional benefits set up for the benefit of charities beyond the fact that individuals are saving more in taxes, and hopefully from that space and a better economy that we had for quite a period of time, we're able to make some charitable donations. Well, suddenly the economy began to have difficulty as the coronavirus came into existence. But prior to that, there was the Secure Act passed in late December that was effective in early January. It's very important to the wealth management field as it related to their clients. And it was really designed to raise revenue without increasing income tax brackets. Certain changes were good for our high net worth clients in that it didn't require them to take IRA distributions. And as the son of a farmer who saved into an IRA, he was never interested in taking that money out. And he was happy to defer his payments as long as actually possible. And the Secure Act pushed that out from 70 and a half out to age 72. They're still going to be required minimum distributions, but if someone is still working at 70 and a half, they can defer those and they can actually continue to contribute to their plans. And it also improved access to annuities within 401k plans. And it eliminated some potential liability for employers. But some of these changes from the Secure Act were considered bad by our high net worth clients who wanted to pass these IRAs on to their heirs. Prior to the act, wealthy individuals could stretch their IRA out for the benefit of their children or grandchildren, and there was no limit to how long that could take place. But now there's a requirement that the entire IRA be distributed within the 10th anniversary of the participant's death. Now there's no schedule as to how those distributions are taken. They could be taken on day one, or they could be deferred up until the absolute last day of the 10th year. There are a carve out for eligible designated beneficiaries like a surviving spouse, a minor child, disabled or chronically ill beneficiaries, and beneficiaries less than 10 years younger. So the result is many beneficiaries are going to be receiving funds and paying income taxes far sooner than our clients had planned. It's also become very difficult with a lot of the stretch IRA planning that was done using conduit or pass-through trusts for those vehicles to be used. So it's really important for your clients that have large IRAs to come in and do some planning with you. And it's really time for a collaborative planning, because this has created an incentive for what are called qualified charitable distributions, we'll cover later, as well as naming the IRA, naming a charitable remainder trust as a beneficiary. And important to remember for your clients that are philanthropically minded, that are planning on leaving something in their estate to charity, that one of the most efficient beneficiaries for their IRA is a nonprofit. Steve?
The CARES Act, enacted in reaction to the pandemic in late March, made some important changes here, broader than what we can discuss in the time that we have, but in relevant part, the increase in the limitation on charitable deduction. You're probably aware that the law has been that contributions of cash to public charities can be deducted up to 60% of the adjusted gross income of the donor. But for 2020 only, that limit was increased to 100%. This is something that is going to be a benefit primarily to the high net worth individuals. Other folks can't afford to be giving away 100% of their adjusted gross income. Importantly, this applies to cash gifts to all operating charities and public charities, with a small list of exceptions. We've seen disaster-related loosening of the limits on deductibility in the past, but always it has been, if you give to a hurricane relief charity, you can deduct it up to 100%. Or if you give to the charity serving the victims of 9/11, you can deduct to a higher extent. There's no restriction based on the type of, or the area of focus of the charity. Any public charity other than a supporting organization or a donor advised fund will qualify, and any private operating foundation will qualify. Private non-operating foundations, grant-making foundations, don't qualify for the 100% limit. This works for gifts made by certain pass-through entities, S corporations and partnerships. If the giver is a C corporation, the normal limitation is the corporation can deduct up to 10% of its taxable income. But for 2020 gifts, that limit is increased to 25% from 20. Additional less talked about benefits. Net operating losses can be carried back for up to 5 years, and losses can offset up to 100% of income. There's a potential impact in the change of the tax brackets. Some important changes in the CARES Act. So let's talk about the first strategy to be considered in today's environment. It is directly out of the CARES Act. It's that cash gift to a public charity, deductible up to 100% of adjusted gross income. As we said, that applies for operating foundations, and public charities not for non-operating foundations, supporting orgs, and donor-advised funds. The result is, always in the past, the rule of thumb has been you're better off to give an appreciated asset to charity than you are to sell it, recognize the gain, and give away the cash, because not all of the gain is going to be deductible because of the limitations. This may be the first time where that rule of thumb gets reversed, at least for gifts made during 2020. It may be more advantageous to sell and give cash than it is to give appreciated assets. At the very least, it warrants some careful number crunching before making that decision. And so donors should work with their wealth managers, their accountants, their lawyers to evaluate and make the best gift if they're talking about a large gift that implicates this relaxation in the deduction limits. There are strategies to be considered: harvesting tax losses and combined with recognizing gains, or applying the net operating loss carrybacks to take advantage of a unique opportunity in perhaps making liquid certain non-liquid assets. The second strategy, John, is the charitable lead trust, and our subtitle is "There's No Time Like Now." Those of you who are familiar with lead trusts will know that there is a level of complexity, an array of choices within the world of charitable lead trusts that could occupy our entire time today. We're not intending to take the time to go into every feature or aspect of a charitable lead trust. Rather, our intention is to give you enough information so that you can understand that 2020 should be the year of the lead trust. So the lead trust, how does it work? It's a trust that makes an annual payment in a fixed percentage to charity, and then upon termination of the trust, the trustee distributes the remaining assets to designated non-charitable beneficiaries, typically the family of the donor, or into a trust for the benefit of those persons. There are other options. The assets can come back to the donor, but the most efficient strategy is to use this as a mechanism for transferring assets to family members or other non-charitable beneficiaries. The tax angle: remember, you're making a gift of the remainder interest to those non-charitable beneficiaries, and that's a taxable gift. You have to confront the gift tax. But the present value of the income stream to the charity is available as a gift tax charitable deduction. And I emphasize here gift tax. I have in my career not been able to convince the number of clients that I should have to consider a lead trust. And I've thought about, why are we not seeing more lead trusts, even in today's times, that call out like no other for consideration of a lead trust? I think it's because we have mentally compartmentalized the lead trust in a way that has us explaining the lead trust after we've talked about the charitable remainder trust, after we've talked about other gifts that are designed to produce an income tax deduction. Yes, you can structure a lead trust to produce an income tax deduction, but that's not its major focus. It is primarily a vehicle for avoiding the gift tax or reducing the gift tax, or if done at death, the estate tax. We as estate planners should be helping our clients to understand that this is an estate planning vehicle rather than an income tax deduction vehicle at its heart. The best asset to consider is one that can produce sufficient cash flow, either because it spins off cash or can be sold in small increments, and will also appreciate at a rate that is at least equal to the Section 7520 rate, which, as I mentioned, is a relatively low bar these days, it being only 60 basis points, 0.6%. Next slide. So why now? Well, first of all, we're dealing with depressed asset values. That they have already reduced the gift tax costs of transfers to the non-charitable beneficiaries. Secondly, the way the present value of the income stream to charity is calculated, low interest rates increase the present value of that income stream, which increases the gift tax deduction. So if you start with an already reduced gift tax cost and take against it a larger gift tax charitable deduction, the net cost is in terms of gift tax is reduced. The effect of the lead trust is that appreciation in the asset base in excess of the assumed growth rate in the actuarial calculation of present value transfers free of gift tax to the income beneficiary, to the remainder beneficiaries, I mean. The assumed growth rate is the Section 7520 rate. And so appreciation in excess of 60 basis points over the term of the trust is going to transfer to family members without any gift tax cost. I can't do this without crunching a few numbers. Let me walk you through. Here is a particular set of variables. I've assumed a 5% trust, one that's paying 5% a year to charity over 20 years. Let's say this is a trust created by a family whose children are teenagers, and they want the children to inherit, but not at this young age. They'll want them to inherit when they're 35, 40, something like that. So let's put if this is a wealthy family who can afford to part with assets now, let's put them into the lead trust, hold them for 20 years, paying out money to charity that the family was probably going to give to charity every year anyway. And here are some rough numbers. Let's say it's done with $20 million. The gift tax deduction, that's the number in green, is 68%. And so the taxable gift, 68% of 20 million, it's actually 67.956, if I'm not mistaken, if memory serves. It's about $6.4 million, and the gift tax cost is $2.5 million. Not bad, considering that if you had given away $20 million at a 40% gift tax, a direct gift would have been an $8 million gift tax cost. Next slide, John. But these calculations are a 7520 rate of 4%. Something we've seen during my career. We've been much higher than that a number of times, but that's not today's rate. Today's rate, John, next slide, is 60 basis points, and the deduction percentage isn't 68%, it's 94%. That's the difference that the change in that one variable, the lower Section 7520 rate, makes on the lead trust. And so, next slide. If we transfer that $20 million with a deduction of 94%, the taxable gift is $1.2 million, and the gift tax is less than $500,000. Probably an amount at $1.2 million that could be covered by some remaining gift tax exclusion, still left over and unused from the 2017 Tax Act. This could be a zero gift transfer for the benefit of children. Next slide. I filled in the whole matrix. the more intense the color, the better in terms of charitable deduction. You see more than a third of this matrix, from 2 to 10% and from 6 to 25 years, is covered by 100% deductions, where there's never been so much of this chart that's green at any time during my career at a 6 basis point transaction. Now really is the time to do the charitable lead trust. And for a client that is philanthropically minded, is going to be giving money away to charity anyway, the payout from this trust can be money going to charity that was going to go there anyway, and the large charitable deduction against gift tax is enabling the donor to pass these assets to a trust for, in my illustration, those teenage children that will pay out to them at some point when they're mature and able to handle the funds, but pay out at substantially reduced, and in some cases reduced to zero gift tax cost. The lead trust, if ever there was a time to do the lead trust, today is that time. You may be asking yourself, can I apply the two concepts? Can I create a charitable income tax deduction up to 100% of my adjusted gross income for a gift to a charitable lead trust? No, it doesn't work that way. The lead trust gift is not deductible at 100%. But as I said earlier, this isn't, while you can produce an income tax deduction, this isn't about the income taxes. This is about reducing the gift tax cost to transfer assets to children. John?
Thank you, Steve. And one of the numbers that Steve and I discussed in preparing for this is that in the dozens of years that there's been a discount rate for transfers and gifts to charity, there's only been 2 months in recorded history where it's been below 1%. And that's last month and this month. So again, there's a chance it could go a tiny bit lower, but I don't think it's a chance to, or time to really wait. And what's interesting with these 75/20 rates, it allows you to use the rate for this month, as well as the following 2 months to look back 2 months. So planning and discussions you can have today don't have to be completed in June. They could be completed as late as the end of August, even if the rates increase from here going forward.
John was saying, made the comment yesterday, if you don't do the lead trust now, you're going to be at the golf course next year talking to your buddies, and it'll be like feeling bad because you didn't refinance your house when the rates were at 2.6%, and now they're up to 3%, and it'll seem like, well, no reason to do that. We should wait till it comes back down. Even if you don't capture the low at 0.6%, this time of low rates is driving down the cost of transferring assets to family members via the lead trust. Now is clearly the time to be talking about it with your clients. On that matrix that I referred to earlier, it's on there. It's one of the strategies that is ideally suited.
Good. Thank you, Steve. And there's a couple of strategies we'll cover here around Iras as another way of transferring wealth to your family, making sure that they're provided for so that long-term you can begin to think a little broader for the ultra high net worth families and consider where they can make gifts to charity. The Secure Act caused this inability to stretch an IRA out for an extended period of time. And what that's causing is individuals with large IRAs, and some individuals that we've done in our research over the past few months just are really astounding. They're multi-million dollars. I remember hearing about the first IRA that was over 5 million, and then it was over 10, and then it was 20. And I had a discussion with a gentleman on the board of a regional bank, and he said they had dozens of clients with IRAs over $50 million. And those families especially are really confronting the issue of how do they pass this wealth on to their kids, how to best structure it, what are their options, and how does it tie in with their goals for their family, but also their philanthropic goals. And so I'm going to move quickly through this because the charitable remainder trust that under the Secure Act is allowed to be coupled with an IRA is very similar. It can be an annuity trust, a unit trust. It can be set up as an IMCRET if you want to defer income. So that is all similar to what you've heard. The part that's interesting, because it's so brand new, is exactly how these are going to work out and how they're going to be structured. What we do know is that the IRA CRT will have a lot of benefits. It's going to allow for the beneficiaries to receive cash flow, not just over a 10-year period, but to have an extended period of time as long as the CRT qualifies under the remainder value analysis, that you can extend that cash flow out for a period of time, but you have to be sensitive to it. Because the heirs are going to receive the present value of the cash flow, it is considered a gift or a testamentary bequest to them, and it will be subject to estate tax. But on the other hand, the donor is reducing the value of that gift by having a remainder value that passes to charity. So it can reduce the amount of estate tax on transfer and still enable a wealthy individual to pass cash flow on to his heirs. And also, it's really important to remember that this planning has to be done during lifetime. The CRT has to be established, and it has to designate the IRA. It has to be designated as the IRA beneficiary before the individual passes away. And here's just a quick model on how it works. Here's a $8.2 million IRA. We assume it grows at 6%, and the charitable remainder trust is named as the beneficiary. So it's transferred at death, on the second death. And we assume that the heirs are receiving a 5% payout for 20 years. Based on their ages, it couldn't be extended longer. And the heirs would receive $9.3 million in taxable distributions. Almost all of that would be ordinary income, most likely. And then the heirs, if they are philanthropically minded, they can choose to gift some of that income or potentially terminate the trust and transfer the corpus early to charity. And Steve, we didn't get a chance to discuss this over the past few days, but would it be possible, have you seen anything in writing yet allowing for the termination of an IRA CRT early and that income stream to pass to charity?
I haven't seen it. This is a new strategy. It's just gaining traction since the Secure Act came out in January. We're early for that, but it's something to keep your eye on.
Right. So then the bottom line is the remainder will pass to charity, and I've seen a number of charities get excited by this legislation. We are beginning to run these calculations for clients and look at them on both the present value for the family as well as the present value for charity. And we are beginning to come to the point that, again, every situation is different, but for many individuals, it may be more advantageous to look at a different planning technique, such as the one that Steve discussed around a charitable lead trust as transferring long-term wealth to the family, but it may be coupled with this IRA CRT would be a good combination of the two. And so again, in this example, the $10 million can be distributed out of the charitable remainder trust to designated beneficiaries. The example we gave here was for education, and it can be a very impactful way. But we also wanted to discuss in 2020, again, another what we feel is unique opportunity with Roth Ira Conversions. And we are, again, as advisors, all familiar with this, but we're also familiar where very often the tax advisory community or the wealth management community will say that it's not the right time. Now, when you convert an IRA, you have to pay a large amount of current income tax. What's unique in 2020 is if you are of a mind and you have the capability to also do a charitable gift, either to a lead trust at a lower deduction against AGI, but more importantly, as an all cash gift, this can be a unique year to combine a large cash gift in support of charity and a conversion to a Roth IRA. So the facts here under our second bullet there's going to be significant tax impacts, and that's why you need to work with your fellow advisors to make sure that we're covering all elements of a Roth conversion. There's ordinary income owed on the converted portion. The Roth IRA from that point forward will no longer be subject to income tax, ever. You've basically taken an IRD asset and created an asset that will no longer be subject to income in respect of a decedent. The Roth itself is still subject. I said gift and estate tax. It's actually just subject to the estate tax. It cannot be transferred during lifetime, but it has become a very tax efficient asset for heirs. And if you combine this Roth conversion, it's going to help mitigate and reduce current and future income taxes for your heirs. Again, remember that cash gift in 2020 gets you the tax deduction at 100% of AGI, so you can pair that and size it so that it helps reduce the tax that's owed on the IRA conversion to a Roth. So again, it can be with the cash gift. It can also be an ideal year to use it with a CLT. It's just calculated at a different rate against your AGI. But it's a great way to benefit charity and create tax-free income bucket for yourself or your family. Here's a simple $2 million example. Client discussing benefiting a grandson who's age 30 currently, has a $2 million IRA. And so we ran the numbers and said, since we can't do the stretch IRA, what are the options? And if we looked at the IRA growing at 7.2%, to make the math easy, then 10 years from now, if it's the donor, the client passes away, leaves the IRA to his grandson, and it grows for 10 years, the IRA would grow to about $4 million. That's the maximum of time it would be allowed to grow tax deferred, and then tax would be due on that, and that would result in $2 million approximately net after tax in California if we use it as a 50% combined federal and state rate. And the issue with the IRAs is they are taxed at the highest rate because you're paying ordinary income, you get no step up, and you're never working with capital gain rates. So you are in the highest tax bracket from $1. If the client, and that's assuming there was no estate tax on the transfer, that they were still had their full gift tax exemption. And what we did is we compared that if the individual, when they're going through this planning, converted to a Roth IRA this year instead of using the traditional IRA, and they made a cash gift to offset the taxes owed at the time they did the Roth conversion, we wanted to understand how much more that would net the grandson. So at the end of the same 10 years, since no income tax is paid on distributions, the Roth IRA has grown to $4 million, and there will be no tax owed, versus the $2 million in the earlier example with the traditional IRA after tax. But now we've said, let's fast forward. Let's say the grandson who was 30 when he inherited the IRA, and we compared it at age 40, now says, I'm going to let this grow for the next 30 years for my retirement. And we assume the same 7.2% growth. And here's where the numbers get interesting. By age 70, the Roth IRA has grown to $32 million. We know that because if it's making 7.2%, there's no taxes, and it's growing, and there will be no taxes upon distributions in the future. Compare that to the traditional IRA inheritance, where they paid $2 million, and then they invested from that point going forward. They won't be able to put that money quickly or easily into a Roth without paying a significant level of tax. So we just assumed that they were able to invest in a taxable environment, but somehow not pay any tax. Even under that most optimistic scenario, they've still only accumulated $16 million. It wouldn't be, and it would be subject to tax when they began to take distributions, either at capital gain rates, but it would be a significant difference. And all of this was created from somebody being willing to make a $2 million cash gift in 2020. So there's a cost to the cash gift, and there's a cost to paying the tax. But if your gift helps you offset the tax, that sets up a situation where now you've created an incredible estate tax transfer for heirs. And if your heir is going to receive either a Roth IRA or a traditional IRA, they're subject to the same estate tax. And if you had to choose between the two, you would choose to inherit a Roth IRA every time. So consider that as you talk to your clients about combining a Roth conversion and a cash gift combo in 2020. One of the things that we wanted to talk about is what we're now calling the compound gift. In the introduction or the invitation to the event, we were still calling it the bonus gift, but we've started to call this the compound gift. And what we found is a way to use tax savings from charitable contributions so that they compound, just like compound interest, which all of our clients and donors understand, this concept of compound giving by gifting the tax savings. And so we use an example of anyone gifting either cash or appreciated assets. It results in an income tax deduction and tax savings. What's unique with 2020 is those income tax deductions can be used quicker and the tax savings realized sooner. So the donor pledges not only the original gift, but he also pledges the tax savings that are generated from that original gift. And what that creates year after year is compounded tax savings. Those tax savings are given again, which creates more gifts, which creates more deductions, which creates more tax savings. And if you can encourage a donor, if you can inspire them as they make their $1 million major gift or a multi-million-dollar gift for a university or a hospital, that are they willing to do the gift and gift the tax savings? And if they are, it will, in a state like California, with a 50% maximum tax bracket, federal and state, it will double the size of the gift. And where donors may not be able to do this all years and at all times, it is a unique year where the need is great, the tax legislation supports this, and the benefits are tremendous both to the individual, to their philanthropic giving, and most importantly to the charities in our community. So this, we believe, is ideal from where we sit for individuals who have IRD assets or inefficient assets they no longer need. Examples, concentrated stock positions that have maybe not highly appreciated, and maybe they've come down in value because of the correction in the stock market. Maybe somebody has harvested losses due to the drop in the market, and now they can match some losses to some gains and create a pool of cash. Someone can have non-income producing real estate that they've held off and they're now sold and they don't feel like doing an exchange in 2020. Bonds, if you can forego the income. Insurance policies in the estate are a great tool for doing this with. Annuities it is a great year to transfer an annuity to charity, art, or even valuable personal property. And we think 2020 is a unique year that we can compare the benefit of a traditional gift of appreciated assets, as Steve was saying, and compare that to a sale of assets with a gift of cash instead. Both of these are good for the donor, good for the community, but we can use the financial modeling tools we all have to analyze it and determine which is better for the client, which helps them achieve their objectives and support the charities in their communities. And this compound gift is really a combination, we see it, of both a major gift with significant plan giving opportunity. So for those of you listening who are working with nonprofits, you know the sometimes tension, the conflict that can exist between your major gift, your advancement, your capital campaigns, which revolve around current gifts, and your long-term deferred or planned giving programs. The compound gift, we believe, is an environment that the two can come together and allow the advancement team, the foundation team, to work together and collaborate with the same donor and help them make an impact today, but also an impact in the future. And it's important to realize is a lot of the planning today for estate planning is triggered through a belief that the income taxes are going to increase, that the estate taxes brackets will increase, and the amount of the exemptions will decrease. But what's interesting with this compound gift is if you can be confident in making a large gift today, as the tax brackets and the AGI and your adjusted gross income increases, the value of those tax deductions, if they are carry forward deductions, not all used this year, actually increases over time. So as taxes become higher, the tax savings get greater, and that helps increase the amount of compound giving that's done. I wanted to look at a real simple example that we did at the end of last year. An individual made a large charitable gift, and we talked to them about what they wanted to do with the gift. They could either gift the tax savings and give it outright to the charity and let the charity use the money each year, and they contemplated that. But because the gift they made was so large and they were inspired to make a large major gift, that it created so many deductions that they were going to have to use those deductions over many years. So we set up a strategy where they set that money aside. They actually put it into a life insurance policy, and they pledged that policy for the future use of the charity. They named the charity as the irrevocable beneficiary. They promised through a collateral assignment they would never borrow against the policy, and they're going to accumulate the tax savings while they burn off the tax deductions, the carry forward deductions from the first gift, and then in the future they will transfer that policy to charity. And at the time they do, the first bullet point there says that they'll use the ITR value along with an appraisal, and that will be another gift they'll be making to the charity. It'll be made entirely out of the tax savings that they've accumulated for the charity's benefit. And then they're going to pledge, and they actually have pledged, the tax savings from that gift as well. And this will create an ongoing series of compounded savings. And I've got an example I'll show you. And at the time of death, the charity will have received not only the original gift, but now a additional gift from the charity in the form, from the donor in the form of the full death benefit. And what's really interesting is this second gift, when you use the compound gifting, the deferred gift you set up is done at no out-of-pocket cost to the policyholder or the charity. It's the gifted tax savings that are either making cash gifts to the charity or paying a premium that the charity will get the death benefit on. And we design any policies we use in this scenario after careful study over several years for maximum premium flexibility in case the tax laws change or AGI levels of the donor changes or the donor's health changes. So we want to build flexibility. Here's the actual case study on this client. They had approximately $1 million of adjusted gross income. They were able to make a major gift of $2.4 million, and they were in approximately a 50% combined federal and state tax bracket. So in the first year, you see here the gift is $2.4 million. Because it's subject to 30% of adjusted gross income, it was an appreciated gift. They were only able to use 30% of their adjusted gross income, or $300,000, and they had to carry forward the balance of the tax deduction. And as you see, they generated $150,000 of savings. They accumulate that for 6 years, and they're able to transfer $900,000 to charity. Then they gift that to charity, and they create another period of giving. And what it did is over 14 years, they were able to gift $1.8 million in tax savings, and they were able to buy a policy that was going to provide $5.8 million to charity, all done with no out-of-pocket cost to them beyond the tax savings themselves. And what I wanted to do for today's presentation is show the impact of the CARES Act. That same gift done this year for somebody that had higher adjusted gross income and was able to use 100% of it this year has no federal carry forward on the gift. And what it does is it allows the money to come in sooner, be gifted all directly to the charity rather than held by the donor. That gift comes immediately. It brings a bigger impact as far as present value. And what it enabled is, even though the company had changed their pricing and the pricing of the insurance was more expensive, it still allowed for the benefit to increase from 5.8 to over $8.2 million. This is an example where someone did want to use insurance and qualified it, but it's no way a requirement. People can gift those dollars outright to charity, and the need is very great right now. And I think what's interesting is those dollars can be applied immediately And it's just a discussion that we suggest the advisors have with their clients and that the charity representatives have with their donors. There are, we believe, a lot of underutilized assets that can become a target for this compound gifting. We mentioned some of them. We're going to need to move quickly here for the balance of the presentation. And I just wanted to talk about one more idea, which is the qualified charitable distributions. Currently, there's $100,000 that any individual can leave through a qualified charitable distribution on a one-time basis or annually going forward. We used an example here of a husband and wife, each having Iras that they didn't need, and after analyzing the planning, didn't want to leave these to kids, but they still wanted to have access to most of it, but they could still give $100,000 of value. And what we looked at here is if they together gave $200,000 a year and that money was endowed, that would grow over time. Over 20 years, they would have made a total of $5 million if the money grew at 5% and was endowed and was paying out 5% a year. They'd have $5 million at the end of the 25 years. We also compared that to if they were to put that into insurance and what type of benefit that would bring them. Finally, I just want to finish up with what we see as a shift in planning for our clients. Wealth transfer, we believe in 2020 has never been easier. And it's really causing our ultra high net worth clients to bump into the question, how much is too much for my kids? And what we're seeing is our clients are beginning to have the discussion around philanthropy earlier. Wealth is transferring at younger ages. Gifting's happening during lifetime. And by helping our clients reposition their balance sheet to achieve the desired results, we're seeing the following, that they're giving a lot more time and planning to how non-qualified assets can best be passed to their children through step up in basis. And we've listed a number of the assets we're seeing go to heirs, and a real shift of the IRD assets, the qualified retirement plans, annuities, and even life insurance now passing to philanthropy, because the family is able to transfer so much wealth and they're reducing the amount of the taxable estate that they're now able to shift some of those dollars to charity earlier. Steve, do you want to take this last slide?
So summarizing, cash gifts to operating charities would take advantage of the 100% AGI deduction, the charitable lead trust, the IRA CRT, the pairing the Roth conversion with a major gift, the compound gift that John has referred to, and other intelligent uses, leveraging the qualified charitable distribution. There are other wealth transfer strategies to be thinking about in these times. The gifts to family members in various strategies. Today's the time to be talking to the clients, especially those clients who can afford to take the long view and consider strategies they haven't pursued in the past.
Thank you, Steve. And Carly, thank you for giving us a few extra minutes. I know I ran a little long on my section, but wanted to give time for some Q&A. I'm sorry, could you repeat that? I didn't
we're not hearing Carly.
So Carly, you're off mute, but it's a little hard to hear you.
Well, they're sorting that out. I noticed in the chat a couple of questions, and I'll just jump in and try and address them. And Carly, we hope to have you back very soon. Someone asked about, with respect to the lead trust, what kind of charities can be the charitable beneficiary of a lead trust? And the answer is any qualified charity can be the beneficiary of a lead trust. It's a little more restricted when you're giving to your own private foundation. There are some extra steps to be taken, but it's not like the 100% deduction limitation, where it is only public charities that are possible recipients. Another member of our knowledgeable audience pointed out very truthfully, correctly, that the states have not yet conformed to the 100% deduction limit. We're hopeful that that will occur, especially for our favorite state. But still, for the right donor, even just getting the 100% limit against federal income tax is going to be beneficial. And then finally, there was a question about generation skipping. And if that question is directed at the charitable lead trust, one of the details that we didn't skip over in an effort to simplify, that we didn't touch on, that we did skip over in an effort to cover the important aspects of timing of doing the lead trust today, is the different varieties of lead trust, the charitable lead annuity trust and charitable lead unit trust. The generation skipping, if the beneficiaries you're giving to are grandchildren, you need to use the charitable lead unit trust, and the deduction calculation is different in the lead trust. The upfront deduction is different, is less. So when giving to for the benefit of a grandchild, use the lead unit trust. When giving for the benefit of children, use the lead annuity trust. Carly, are you back?
Oh, I don't think she's back yet. I'll take a turn, Steve. I saw a question here on the gifting of annuities and what the income tax consequences. And so when an annuity is gifted, it's treated as if it was surrendered. So if you have an annuity and somebody's put $1 million into it and it's grown to $2 million over time, very often in the past, both ourselves and their advisors would talk clients out of not gifting that, because you'd create $1 million of income on the gift of the annuity. What's unique in 2020 is if this is an asset that you're not planning on using yourself, and you understand the taxation going to kids at losing 70 cents on the dollar of all the growth, if you're subject to an estate tax, that you may be better off gifting that to charity. And what's interesting is there's no benefit to waiting and doing it at the end of your lifetime. You can be motivated to do it now, especially in 2020, because you will receive a income tax deduction that more than offsets the income. In that example, you get a $2 million deduction, you'd only have $1 million of adjusted income. So as long as you had the ability to use the rest of the deduction, you could use it that year. Otherwise, it would carry forward to a later year. So again, for the first time, even if the basis goes down to almost zero, you'll net a net positive on the surrender and the gifting of an annuity in 2020.
Okay, Carly's just figuring out how to dial back in.
Okay, good. Steve, you want to grab another question there?
Those were, I may be looking in the wrong place. Those are the only ones I saw. Is there another one?
No, I was just looking in the chat, and again, I'm respectful of everyone's time. Steve and I can stay on a little longer, but we wanted to give everybody space to terminate the call if you'd like. And again, on behalf of Bill Super and the North County Estate Planning Council, thanks for the interest in planned giving. Thanks for attending today's call and webinar. And I think whether we're an advisor to wealthy donors, if we have the ability to be a donor ourselves, or if we're just in a position to inspire others, to talk to them, to educate them about the opportunity in 2020, I think we're uniquely positioned this year to do the absolute best work of our careers. And I think across all of the North County estate planning community, We have a lot of varied causes that we're passionate about. It differs. They're all across the board, as they are for our clients. But I think this is the year that we can work together. We can inspire philanthropy across a lot of different causes. And that's the beauty of this current CARES Act and the 100% of the AGI. We can use it to benefit any operating charity. So let's work together to make a difference. You know, align yourself with other advisors. Choose somebody that's not necessarily in your specific field, and I think together you become a team. Think about joining a planned giving advisory committee for a nonprofit that you believe in. Attend courses like the Trusted Charitable Advisor at the Jewish Community Foundation, and look to some of the websites that are out there around information about planned giving and some of the educational formats out there. We hope this is the start of a dialogue, and we hope this will continue, and that together we can help our clients bring about great change in 2020. Thank you, everyone.
Well said, John. And if you're interested in these topics and you'd like to carry on a conversation with either John or me on the side now or going forward in the coming days, we'd be happy to participate.
And we also saw that there was a number of key points here on the chat. I'm just getting into it. I think we hope that Carly would be able to sort through that. So we'll try to respond and follow up with those of you that didn't get your questions answered in the presentation itself. Thank you again. Ollie, are you still there?
Yeah, I'm still here.
Okay. Is there any way to capture what's in the chat?
Yeah, we will send you guys all of that information.
And as far as is everyone else is disconnected, or are they still on?
No, there's still people signing off. I can terminate us 1 sec.
Well, I mean, and we're also happy to stay on if there's additional questions, but I think we're probably running long enough.
I think so. 1 sec.
Thanks for all your help.
Yeah, I think we're done.
Awesome.
Well, thanks, guys.
Okay. Thank you. And so you do have the chat information?
Yeah, I'll send that over to you.
Okay. Hey, thanks so much. Thank you, Steve. Thank you, Charlene, Carly.
Thanks.